Good morning, everyone. My name is Arnold Javero, and I work with S&P Capital IQ based in New York. So apologies ahead of time for being a little groggy. I think it's about 5 o'clock in the morning still, so I'm still on New York time. My team supports the S&P Capital IQ Project Finance Default and Recovery Consortium. For the next few minutes, I would like to give you a brief overview and update on the trends we are observing in the consortium portfolio from the perspective of new issuance, defaults, and finally recoveries. Let's see, sorry. Before I begin, please note that this presentation is an abbreviated version of more in-depth analyses S&P Capital IQ performs using the data provided by the S&P PF Consortium. We use percentage-based data in our presentations because publication of details are reserved to maintain confidentiality of individual participating banks' portfolio data. For those of you who are not familiar with the consortium, it was started back in 2001 by a small group of global investors interested in creating a credible data source that could provide objective default and recovery benchmarks for the largely unrated universe of project finance debt instruments. Since then, the consortium has grown to include the performance information from the PF portfolios of over 30 lenders and investors. As of 2014, the database has evolved to become one of the largest sources of global PF default and recovery information, covering close to 8,000 projects originated between 1980 and 2014. Includes 624 defaulted and 377 resolved projects segmented across 7 global regions and 10 industries. I mean, as you can see from the map, Western Europe, North America, and Asia Pacific make up over 70% of the consortium portfolio. Western Europe by far represents the largest regional concentration, which interestingly contrasts the rated universe of deals where the US dominates. The table below gives the region versus origination year distribution of the consortium portfolio. Since approximately, if you notice, 80% of projects were originated before 2009, which in our analysis has indicated that on average, most projects within the regional cohorts contribute approximately 11 years of continuous performance history, or roughly a time series starting around 2004. Some of the largest concentrations in terms of countries include the UK, Spain, France, Germany, and Italy in Western Europe, in the US, Canada, Mexico, in the North American region, Japan, Indonesia, China, and the Asia Pacific region. The table above gives the region versus industry distribution of the consortium portfolio. As you could see, I don't know if you can really see it that clearly, close to 80% of the database is represented by 3 segments. Let me see if I can sort of highlight this a bit. Right? So right about here, these are all relative percentage base, basically on a relative percentage basis. So essentially represented by 3 industry segments. So they're power, infrastructure, oil and gas transactions. Over the past 5 years, there's been a steady project finance growth across all global regions, particularly, or most recently, in the Asia-Pac and the Latin American regions. Over 1,500 new projects were reported. And particularly, again, they're concentrated in the power, infrastructure, and oil and gas subsectors. Across, in terms of country concentration, in Western Europe, I guess in terms of rank, I don't know if I can really say this, but it's essentially Italy, Spain, UK, France, and Germany. In North America, countries that dominate the new issuance are the US, Canada, and Mexico. In the APAC region, it's China, Japan, and India. Within infrastructure, right, new issuance is driven primarily by the transportation subsector. And not surprisingly, the country contributions are very similar to the power industry. Next, I just want to discuss the annual default rate trends. And as Mike pointed out, we are going to do a little bit of a comparison between the PF consortium results in terms of defaults, the rated universe of defaults versus the corporates. S&P Rating Services has rated about 514 project finance debt issues since 1991 with an annual average default rate of 1.5. If you could see, in 2007, the annual default rate was approximately 0.5 or so, rising in 2009 to 0.75. While many corporate borrowers defaulted during this time span, project finance showed resilient performance. This can be likely attributed to the various contractual provisions, such as offtake contracts and concession agreements, which provided more stable performance. But I guess the takeaway I really want to point out here is that while the performance of the PF consortium went down a bit here, or is pretty much stable and decreased, the rated universe is actually a little bit higher, but this can essentially be explained by the differences in sample size. But generally, and I unfortunately can't really divulge what happens after 2012, performance is essentially stable or stabilized. Turning now to defaults. The table on top shows the distribution of defaults by region and industry as a percentage of the consortium's default exposures. It probably comes as no surprise that given the portfolio's high concentration in power and infrastructure, we see a correspondingly high number of defaults across the CD segments. While total gross numbers across industry and region cohorts has some value, they really don't give you a sense of the trends in performance or time dimension. So over the last 5 years, we took a look, and what we've actually observed is an upward momentum in the total amount of annual defaults reported within the transportation, ports and terminals, public service buildings, and water, waste, and utilities subsectors within infrastructure. We see similar performance across both non-renewable and renewable projects in the power segments, as well as in the oil and gas industry, suggesting weakened or weakening credit fundamentals in the wake of macroeconomic changes or challenges. By contrast, we see here the media and telecom industry represents 13%. So going by that sort of same analysis, the timing of defaults within the media and telecom industry happened much earlier, around 2000. So essentially the concentration of defaults happened before. Finally, a brief discussion on recoveries. The bar chart above shows that the tranche level recovery distribution for the consortium portfolio. It suggests that a bullet distribution where the majority of the total number of resolved loans had almost full recoveries, between 91 and 100%. The remaining recoveries were spread pretty evenly across the other recovery buckets. Now, again, wanted to provide a little sense of timing over the last 5 years, what we're actually seeing in terms of recoveries. tranche recovery over the last 5 years across remediation strategies. Essentially, of course, represented by a number of significant observations, suggests overall that timing is everything. The bottom line is, most recoveries, while you see 91% across the board in terms of on an absolute average basis, we've found that if you resolve, with the exception of sale of instruments and debt to equity exchange, the quicker you resolve a project, the loss severity goes much lower, sometimes between 10%, on a 10% basis in terms of recoveries. So I guess the takeaway here is that resolution is important in terms of timing. The quicker you resolve a project, the better you'll end up being. I guess with that, I think I'm going to end. There's not really... Any questions? Yes, sir.
Yes, sorry, two questions on my side. I was struggling to reconcile 2 points. The number one point related to the new issuance trends, that would be on slide 25. I can see transportation pretty low in the new issuance trends versus the previous presentation that was telling us that transportation just took over from oil and gas. That was my number one question. And number two, would you mind coming back to the point about annual default rate?
Annual default rates, yes.
Yeah, I'm struggling to reconcile that with the 1.5% annual average default rate.
Right, it's 1.5% for the rated universe.
Okay, so only the rated one, consortium is excluded of the 1.5% average.
That's correct. That's correct. So they're pretty much independent. Well, not pretty much the default rates are the data supporting default rates is independent.
Understood. But then previously we were told that rated project finance was had a lower default than corporate bonds.
I'm sorry, can you please repeat?
We were previously advised that rated project finance had a lower default rate than corporate bonds, which actually seems to be different, right?
Yeah, the thing is that I had to cut off the actual end results in terms of my ability to disclose what happened in the unrated universe or in the project finance consortium. But the thing is, though, you notice that the total number, and this is, I think, a problem with the sample size. The sample sizes within the rated universe actually diminished. So essentially, the default rate shot up. Oh my! Oh, that's right. Right.
No, I was just saying that the discrepancy you're referring to is because you need to look at over a 10-year period. So corporate bond default rate is still lower than project finance if you look at it over 10 years.
Understood. Okay.
Cool.
Yeah, so it's just a matter of definition. If you could define what you mean by infrastructure, because you have transportation on one side, infrastructure on the other side. So does that mean that infrastructure for you is only social infrastructure, hospitals, schools, whatever?
I'm sorry, could you please, just the echo is really...
It's a matter of definition. Can you define what you mean by infrastructure? Because you have transportation separately as a category. So what do you mean is infrastructure if it's not transportation? Is it only social infrastructure? Is not energy? You could also have energy separately. What do you have in infrastructure?
Within infrastructure, it's predominantly transportation. So
can you explain what you have in the transportation category as opposed to infrastructure category?
Yeah, I think what we're going to do is the transportation segment is a legacy issue, and it represents, I guess, essentially a data issue that we're probably going to have to clean up.
Do you have also the statistics? If we come back on your last slide, do you have also some results in terms of recovery rates per subsector? And I think, for instance, that infrastructure intuitively should have a lower, an higher recovery rate than the other subsectors.
Unfortunately, due to a lot of contractual confidentiality agreements, I can't comment on that in terms of pure recovery rates. But there certainly is a difference across the subsector or subsegments within infrastructure and power. Certainly are.
Hi there. Two quick questions. The first one is, do you have an idea of the percentage of the project finance market that you're covering with the consortium, if you're allowed to say that? And the other question is, in terms of how you define restructurings, do you take the bank's definition of a restructuring, or do you have an independent way of establishing whether a restructuring has occurred?
With regard to the first question, can you sort of...
Sorry, the first question was, with the consortium, how much of the total project finance market are you covering?
In terms of the total market, I don't really have a benchmark against from which I could actually, I guess, compare it to at this point, quite honestly. But it is certainly a considerable amount based on what market studies are out there at this point. I mean, it covers or encompasses 8,000 total deals, starting from 1980. And the second question was?
So the second question is about the definitions of defaults that you're using, whether you are, obviously that would change from jurisdiction to jurisdiction and from bank to bank.
Again, some confidentiality, I guess, constraints with regards to answering that as well. I apologize.
But you don't have an independent way of kind of classifying. Okay.
Wow, I don't have the numbers in front of me right now. If you could come just after the conference, come to me and I'll look at some of the results and I could possibly give you a ballpark figure.
Sure.
I'm willing to provide that. Yes.
I thought sorry, very interesting presentation. I think it is worth noting that in Europe, under the Juncker plan, the term infrastructure pretty much covers all those categories.
Yes.
I think so that's one thing that to be very aware of. Also, I think that you mentioned this issue about definition of default. And you, like many studies, separate the default analysis from the recovery analysis. But
correct.
In order to avoid this definitional problem, if in your data you took from each sort of data point the loss rate,
yes,
and you gave total figures for that, then of course at least we would know the total loss rate should be correct because you're matching the. If you look at the loss rate
straight through,
between the same deal, of course, if you separate those two and then try to reaggregate at the end, you may get the wrong outcome. So in your data set, do you look at loss rates per deal and then aggregate to get total loss rates, which should be quite reliable?
That's actually one of the metrics that we do provide.
Okay, yeah.
It's basically a straight through, so essentially from the reason of default all the way through the recovery process, as well as the choice of remediation strategy. Again, unfortunately, I can't discuss the specifics.
But I don't think any of your slides had the aggregate loss rate. I'm not, unless I missed that. But
no, those were just ranges. They weren't. Yeah, I'm sort of reluctant to provide the actual recoveries.
Then another question: Do you have the? It was mentioned about the spreads. Do you gather from your data set the initial spread that was offered, so that again you can compare then the sort of spread earned to the loss and work out to what extent there was a net
no, we don't
coverage.
We don't
gather that.
No.
Okay. And I guess the final observation more is that you mentioned that the resolution it implied that if you speed up the resolution, you get a better outcome, but I think there may be a sort of causal issue here. It could be that those deals where they know that they can recover most, they deal with quickly, and the ones who are disappointed with the initial options tend to hold out for a better outcome, which may not happen. So there may be a sort of causal...
I could actually comment a little bit on that. We do a study on the actual amount of defaults. I mean, the stated amount of outstanding at the time of default, there is a difference.
Okay.
In terms of the remediation strategy chosen and the time in which it's actually resolved.
Okay.
Thank you very much.